So I want to look at the difference between profit and loss and cash flow, and how a profiting business can actually fail because of cash flow. So first of all, let's look at the definitions of profit and loss. A profit and loss is a financial statement that summarizes the revenue, costs and expenses between a particular period of time in a business. This can be completely disconnected from the cash flow in the business. Cash flow is very simply the amount of money being transferred in and out of the business, regardless of the profit and loss. So in this example, I've got a business, a very simple profit and loss and a cash flow statement for one particular month, but I want to just show you just how drastically different these can be. And in this particular case, this company is actually profiting not too bad at all. This is a relatively new company. So we can see their revenue was 19,000. Their total cost of goods sold was 4,000, so with a 1,500 GP. If you take away the overheads, the net profit of this company in this particular month was £1,000. But let's actually have a look at the cash flow statement then. So they received £16,500 worth of cash and card payments. They received £750 worth of account payments from the previous month, with a total income of £17,250. And look at this compared to their revenue. Now this is net, and this includes VAT. So based on this month, the reason why this month's income on the cash flow side is down so drastically is because they did a lot of account work. So they haven't actually been paid for doing the work that they've done this month just yet. So let's take a look at their outgoings. £5,000 out to suppliers, £1,000 out to loan repayments, and then the business overheads and wages. So a total outgoing of £20,000. So the monthly cash flow, they actually lost £2,750 this month, even though they net profited £1,000. So the key difference being was they did a lot of account work which had payment terms which have not been paid for, and you can see that they have a loan, so they've had to pay for a loan. The loan repayments come out in the month, which again doesn't affect the profit and loss, but does affect the cash flow. And the suppliers in this case was actually they spent the same with the suppliers as they did this month, but you obviously pay suppliers based on credit terms, and depending on what those credit terms are, you could actually pay more to the supplier in a current month than you've actually spent with the supplier that month, just because of the nature of how the bills fall due. So let's have a look at a few factors that can affect cash flow in a business that's seemingly profiting but can fail because of cash flow. So loans and repayments, these can both affect cash flow positively and negatively. So if you receive, let's say you go to your bank manager because you want a loan. If I was to actually add a loan payment coming into the bank into here, then this cash flow could be significantly up. But in most businesses, you'll more frequently be paying out on loans than you will be receiving loans. Particularly if you're investing or you're a new business, the odds are that you've taken a loan out and you have to repay that loan back. And you can understand from this, if your net profit doesn't actually cover the value of the loan, then it doesn't matter how long you go on for, eventually you're going to run out of cash. If your profit, as I said, you will either need another loan to cover the gap, or your profit must cover your business cash expenses and the loan repayments. Another thing which trips people up are payment terms for customers. So if you, let's use this example, if you were to give customers 60 days payment terms, but your suppliers only give you 30 days payment terms, that means all the parts that you fit on your customers' cars, you're going to be paying for within 30 days, but you're not going to be paid for them within 60 days. So this is typically fleet. Fleet is very bad for cash flow if you do a lot of fleet work, because the payment terms can even be up to 90 days. That means you don't get paid for working on those cars for 90 days. You will have to pay your staff the current month, and you'll probably have to pay your suppliers the following month. So you could be out of cash, out of pocket for 60 to 90 days if you're doing fleet work. Suppliers, again, depending on payment terms of suppliers, that can affect cash flow. And a big effect on cash flow is in inventory or stock. Now, you imagine if you put a large order in of stock. Oil is a classic, for example. Let's say you've spent a few £1,000s on oil, and that's going to last you for a few months. If you don't have payment terms on the oil, you pay for the oil immediately. It won't appear as a cost because it's stock, but it will appear under suppliers that you need to pay. So I hope this demonstrates the difference between how you can have a profit in business but still fail because cash flow works in a large respect independently from your profit and loss. Any questions, please let me know. Thank you.